Good afternoon again. I'm Orest Tomaselli. I'm the president of project review here at CondoTek. With me today, I have Lisa Geloso, who's director of our business development and product operations. And what we're going to be presenting today is an outline on Fannie Mae's new lending guidelines and how they specifically impact property managers and board members. We have been inundated with requests for information from the industry, from our clients, requesting us to provide them some sort of, pathway to ensuring that mortgage financing is available for condominium and cooperative unit owners. So about 10 days ago or 2 weeks ago, we provided an industry-wide lender presentation on these Fannie Mae lending guidelines to all of our lender clients. And this webinar is specifically for property managers. But of course, if you're a lender on this webinar, a lot of the information is, specifically what we presented 2 weeks ago, but it also provides board members and property managers with a direct pathway and an idea of what to do as far as their decision making going forward since the issuance of these guidelines. So without further ado, let's jump into this. So I'm Orest Tomaselli. I'm the president of Condominium and Cooperative Project Review here at CondoTek. I was the former owner of National Condo Advisors. National Condo Advisors provided condominium and cooperative project approval for the industry for 13 years before my firm was acquired by CondoTek. So I was very excited to have that transition happen for various reasons. Most importantly, because CondoTek was a technology company providing services into the industry for lenders on condominium and cooperative documents, essentially providing all of the documentation that was necessary to determine whether or not a condominium or cooperative development was compliant. So this transition for me personally has been fantastic. It's gone on now, I think, for close to 2 or 3 months, and very thrilled to have my entire review team here at CondoTek, and essentially having a whole back office now of employees now that have a really good understanding of the condominium and cooperative marketplace. And joining me today, as I said earlier, is Lisa Geloso. On our last presentation, you might have remembered, if you were on that one, that we had some technical difficulties and we weren't able to have Lisa really comment. So Lisa, welcome.
Thanks, Orest. Super excited that you and all the former NCA associates are now integrated into our CondoTek family. I don't think the timing could have been more perfect for you to have joined us just as Fannie Mae gets ready to roll out with their new temporary guidelines. So let's get into it.
Yeah, absolutely. So a little bit more about CondoTek, just to give you an overview. What's interesting about CondoTek is, they really are a technology and information firm. So adding these review services to their product lines was really an easy process, meaning that they provided their signature product called the Condo Pack, which was documents to lenders in the industry for years and had done a very good job and had hundreds of lenders as clients. And for us at National Condo Advisors, it was, again, a seamless transition because now we could provide reviews to those lenders on the condominium docs that CondoTek was acquiring. But additionally, we also now, and essentially CondoTek now, provides all of the rest of the services that National Condo Advisors did, which includes Fannie Mae PERS project approval alignment, FHA project approval, portfolio lending approval to our condominium and cooperative clients, as well as our normal, regular reviews for new construction developers. But added to that is a new product called the Condo Project Warrant, which essentially not only do we provide all the documentation to our lender clients, but we also warrant the projects and ensure that they're compliant with whatever GSE and/or agency they are selling that loan to. So important for this presentation because it outlines essentially our depth and what we're able to do within this condominium and cooperative lending world as it specifically relates to property managers and board members. In many instances, we have already reviewed or the condominium development you're probably living in or managing. And if not, it's it's unlikely that we haven't. Let's just put it that way. We review sometimes over 25,000 condominium properties and 60,000 document deliveries. So we're ubiquitous in this space. That being said, we need to jump in what's gone on recently as far as lending is concerned for condominium cooperative developments. So on October 14th, Fannie Mae dropped a bomb on the industry. I don't think it was necessarily a bad bomb. I think that the spirit of these new guidelines is important. It's important. I think Fannie Mae is doing a very good job at looking at the industry and looking at the risks that are involved in lending into the industry and being responsible in ensuring that condominium and cooperative developments are paying enough attention to their finances, and boards are being very thoughtful about the future repair and maintenance costs to their infrastructure. So these guidelines, essentially the spirit of them was based upon the condominium collapse, the tragic collapse that occurred in the Champlain Tower in Surfside, Florida. I said on the last presentation we did that, that was a, horrific scene to watch. And I think we've all seen the video of that condominium collapse and the tragic loss of life that occurred in that development. And albeit a, very unusual occurrence, there had to be some industry changes, and Fannie Mae's response to that collapse is essentially these new guidelines. I agree with many of the guidelines. There are some that I think are, too difficult to comply with in most instances and don't necessarily speak to the spirit of whether or not a building should be lent in. But this vetting process is important, and it's important to outline that these guidelines technically state that they are temporary. Now, we don't really know what that means, whether they'll be amended or changed. The industry has already taken off in complying with these guidelines, meaning the lending industry. So a lot of condominium cooperative developments are now finding themselves in this position where they must comply in order to get mortgage financing available in their developments. Lisa, any thoughts on this? Have I outlined that properly? Is there something you want to add to that?
No, I think maybe if we flip to the next slide and we kind of talk about the lender requirements that Fannie's talking about, it might be a little bit clearer.
Yeah, so here we go, lender requirements. So Lisa, take it from here. I mean, what are lenders now required to do?
So, basically they're going to be required to make determinations about the project eligibility. And they're going to have to be reviewing additional documentation, which could include commentary required on the appraisal, or detailed information about assessments, and possible review of any violations issued by regulatory agencies. So what does that really mean? It means that we have to get really, really prescriptive and really pointed in the questions that we pose to HOA so that we can be prescriptive back in requesting what we need to look at the information. We are going to be going over questions and examples in our best practices towards the end of the presentation. But I think as we get into the next few slides, we'll be able to go over how prescriptive we have to be and what we need to be looking at.
Yeah. One of the comments here, violations issued by regulatory agencies, it just so happens that a lot of the managers that are on this call are, from the New York area, because, we're so heavy here in New York, where I live, with condominium cooperative developments, right? So, a lot of the regulatory, violations that get issued to condominium cooperative developments come, from HPD or outlined very clearly within a title report. Some are a little bit more mysterious, which, there you could find them, but, in New York, there's something called Local Law 11, which requires an inspection of a facade of any building that's over, I think, 5 stories every 5 years. So there are a lot of violations and or specific, requirements made for condominium cooperative developments through that Local Law 11, inspection requirement. And it's funny, one of the pieces here is that, Fannie Mae is a national agency, right? And they when they create their guidelines, they create them in that fashion. They create them for the whole entire country. And there are not often carve outs for specific areas. So if you kind of overlay New York with Florida and the Champlain Tower, I'd argue that it is likely that if that building was in New York, it's unlikely that it would have ever gotten to the point to where it had the ability to collapse because of Local Law 11. So different jurisdictions have different requirements for buildings and for the repair and maintenance of infrastructure and or facade. And New York happens to be one of them that does it right. So what do these guidelines say? So the first thing that's important for property managers and board members to know is that Fannie Mae has really thrown down the gauntlet. And what they've said is essentially there is this unavailable status that they are now issuing to condominium developments and cooperative developments if it has been brought to their attention that these developments are not compliant with Fannie Mae's guidelines. So I'm going to provide some commentary here that's kind of a little off the cuff, which is, I've talked to some people since these guidelines have come out and said, wow, this unavailable status is, it's a pretty big deal. And they said, well, it's just Fannie Mae and there's so many other lending options. And I said, you don't really understand what this unavailable status means. This is a public declaration that this particular building is not compliant. Once you get on the list, yes, you can get off the list by submitting to Fannie Mae for a Fannie Mae PERS approval. With the appropriate documentation, outlining, the repairs that you made that may have put you on this list or the violations that have been removed. But being on the unavailable list is something that really designates you as a property that shouldn't be lent in. And that's a really tough place to be, regardless of whether or not you are essentially, your purchasers and owners are getting Fannie Mae financing or not. If they're getting portfolio mortgage financing or other, any other type of mortgage financing, even for underlying mortgages or CIRA loans, this unavailable status is a really big deal. So it's important to note that it was effective immediately, meaning the guidelines came out on October 14th. Within 2 weeks of October 14th, there were 930 condominium and cooperative properties that were designated on Fannie Mae's website as being unavailable for lending. That's a big deal. And, lenders are now required essentially to check this status before they extend any type of mortgage financing, but certainly Fannie Mae mortgage financing. So before I go into a little bit more detail on this, Lisa, how do lenders really, on the lending side, I think it's important for the managers and board members on this call to understand how do lenders, check this information, and what does it mean when a building does come up as unavailable?
So good point, Orest. So right at origination, certainly lenders should be checking condo project manager to see if it's listed as not unavailable. And certainly prior to closing, checking it as well. If it does happen to come up on the unavailable list, my suggestion, and Orest, you can opine here as well, is to ask really pointed questions about the deferred maintenance, get information on what's going on in the project, and work with, hopefully, us to see if we can prepare it for a PERS approval. Just because it's unavailable now doesn't mean it might not be available in the future, but it certainly requires a thorough vetting.
Yeah, it's kind of funny, right? There's no real pathway that's been established yet to remove a project from the unavailable status, other than Fannie Mae outlining that you can get a PERS approval to remove it. Now, we're experts in getting Fannie Mae PERS approvals. Been doing it forever and have gotten thousands of condominium and cooperative developments PERS approved. But boy, it's going to be interesting to see what will have to be proven to the agency to remove that status. I mean, what we anticipate is that we're going to have to do a deep dive into the building's finances, look at the engineering reports, provide engineering reports, provide reserve studies. And the reserve study, issue is a big one right now. We're going to get into that in a second. But there's a lot of work to be done to get these projects off the unavailable list. So the point here is development should do everything they possibly can to remain on the available list, which means complying with a lot of these lending guidelines. So what are the other major issues that have come up regarding reserves, which we just alluded to? First of all, and I should say Fannie Mae within their guidance has issued very specific guidance regarding reserve studies. So in many new construction developments, reserve studies for years have been utilized to align the development's operating budget and reserve line item with the appropriate amount of reserve. What a reserve study does is essentially looks at all the components in a condominium development or cooperative development and comes up with a condition assessment, a remaining useful life of that component, and a cost to repair or replace that component over a 30-year horizon. And the reserve studies were utilized essentially to ensure that buildings weren't over-reserving or under-reserving. So in many instances on new construction properties, since all the components were brand new, if you obtained a reserve study and submitted it to Fannie Mae, it was likely that that reserve contribution prescription in the reserve study was far less than 10% of the operating budget. Now, that isn't necessarily a bad thing for unit owners, managers, for the agencies, for the lenders, for all the stakeholders. The reason it's not a bad thing is because our opinion is that if you know condominium boards and how they operate, if you're over reserving and there is an extra amount of capital based upon some sort of throw it a dart at a dartboard 10% number, most board members and property managers are much more fiscally responsible than they're given credit for. And if they know they have too much capital in an account, they'll deploy that capital to different places, to a higher interest-bearing account, or outside of reserves, or stop collecting reserves altogether. And what typically happens, and what we've seen over the years, is developments that started out with a 10% reserve line item often abandoned it, but the developments with a reserve study and an accurate black and white report that said what the reserve contribution should be based upon all the components, those developments kept their reserve contribution. So this is one of those guidelines where we really don't think it makes sense. And I think maybe will be adjusted going down the road a bit. However, the big issue here, excuse me, I like to call it the conundrum, is that in order for Fannie Mae to approve a new construction development, you have to have a 10% line item for reserve. But for most portfolio lenders, you need a reserve study in order to get access to their balance sheet products and lending. So which one do you choose? And the answer is often right now you're choosing both. And how that bleeds into existing established developments is really interesting. So if you're a board member or property manager on this call, you have to realize that, you know, there is also a reserve study acceptance suspense by Fannie Mae for any development that's considered established, which is where 90% of the units have been conveyed to purchasers or owners. And lenders can no longer accept a reserve study in lieu of that 10% budgeted reserve line item. So the only way to get a lower reserve contribution, anything lower than 10% approved through Fannie Mae, is to submit that project through Fannie Mae's global project approval service called the PERS process, which gives a development a 2-year global approval. And you could utilize a reserve study as long as you have enough capital, the reserve study is done correctly, and the reserve study outlines, the financial wherewithal of the building. So that established project isn't barred from using a reserve study for Fannie Mae. It's just that lenders can no longer just sign off on it. It has to go through a process of the PERS approval process in order to be accepted. Now, our recommendations here are really interesting, and they may not align with the rest of the industry or how a lot of other property management firms are looking at it. I mean, I've had no less than 160, I think, conversations with property management organizations across this country since October 14th. It has been very busy for me. One of the biggest issues in not obtaining a reserve study, or for a development that doesn't have a reserve study, is the additional liability that gets created for property managers and board members in answering the questions that are now required to be answered by lenders through condominium and cooperative questionnaires. There is a lot of information within a condominium and cooperative questionnaire that typically board members and or managers complete that a board member and manager really shouldn't be answering unless they have the appropriate documentation and or engineer or structural engineer inspection performed on their building. Essentially, I wouldn't be comfortable in answering a lot of these questions unless I had that in my back pocket and I could point to it. So our recommendation for almost every single condominium and cooperative development is to go out and get a reserve study, because if you have an engineer that's providing the reserve study, is inspecting the property, they have a license, they have the experience to determine whether or not there's an issue with the structure. They have an ability to make very specific, recommendations on what should be done to a property, what the condition of a property is, and how that impacts the development financially, because the reserve study also looks at the financial side of the building. So I understand the guideline. I understand why it was issued by Fannie Mae, but our recommendation almost is, 180 degrees opposite. Our recommendation is get a reserve study, And if you want, put a 10% line item in. Don't necessarily utilize the reserve study only for the contribution unless you intend to submit that development to Fannie Mae for a global PERS approval. I mean, Lisa, that's how you're seeing it as well in the industry, correct?
Yes, and I think for any board members or HOA management folks on the phone today, they have to realize that they're going to be getting some questions posed to them by lenders, specifically if they're aware of any deferred maintenance, via the meeting minutes, or if they're aware of any project-wide deferred maintenance within the project. They're going to be asked to, identify and explain the nature of the deferred maintenance, as well as going out and getting your reserve study. You're going to be asked some really pointed, questions, and I think hopefully this presentation is going to prepare you a little bit further on what will happen in January of 2022.
Right, exactly. So I need to go over basics today with this with everybody who's on this webinar. So first of all, I think it's really important to outline what types of lending are available for condominium and cooperative developments right now and how these guidelines are impacting it. So Fannie Mae lending, obviously Fannie Mae is the largest insurer of mortgages in the United States. They just raised their loan limits in high cost areas, and I know there's a lot of New York managers on this call. The loan limit is the high cost loan limit is $970,800, which means that Fannie Mae, where in the past they would only insure loans up to $720,000 or somewhere in that range, now they're going all the way up to $970,800. So why is that important? Well, a lot more loans and a lot more, borrowers are going to be seeking Fannie Mae mortgage financing. In the past, there was a split between Fannie Mae lending and portfolio mortgage lending, which is essentially balance sheet lending. Lenders, instead of selling their loans to Fannie Mae, would keep loans on their portfolio and service those loans. Now, a lot of borrowers are going to be pushed towards Fannie Mae lending, and that may be because interest rates may be a little bit better, or loan products may be a little bit more diverse. But I will tell you that these guidelines may have the opposite impact. We are talking to a lot of portfolio lenders, and portfolio lending, what it is essentially is that in and of itself is that, lender, whether it's a large, big bank, a Chase, a Wells, a Citi, whatever, they're looking at a development and lending to their own standard guidelines for risk. So some of those lenders that are out there are aligning with Fannie Mae's new guidance. Most are not for their portfolio lending divisions, meaning that if, what we're seeing all over the place is that portfolio lenders are not only allowing reduced reserve contributions with the reserve study, but requiring reserve studies in order to provide portfolio lending. So in a lot of cities, across this country, portfolio lending is going to be the, answer wherein a development can't be Fannie Mae compliant, or frankly doesn't want to be Fannie Mae compliant. And the way to do that, we offer this here at CondoTek as a service where we essentially align the development with specific lender requirements and or Fannie Mae requirements, package it all up, send it out to a lender and warrant that site for eligibility with their guidelines, and let the lender make an internal portfolio lending decision. Those lending decisions are typically made for a year, where a property will receive a global approval from a lender just like Fannie Mae for a year, and it'll have to be updated every year. But they will lend into these properties who, that don't have a 10% line item for reserve, but have a reserve study, or may have had some other special assessment issue or is utilizing a special assessment to do repairs and maintenance, which is one of the other guidelines, which we'll go over in a second. So the third type of lending is underlying mortgage lending for cooperatives. This is going to be impacted by these new Fannie Mae guidelines. We're already hearing from a lot of the risk teams that provide underlying mortgage financing to cooperative developments that they are aligning with many of Fannie Mae's requirements. That's a major issue for the co-op world. Not being able to access mortgage financing in an underlying mortgage is devastating for many properties, for many cooperative properties, and that is likely going to be an issue. There's also Freddie Mac lending, and Fannie Mae and Freddie Mac as agencies are often utilized, interchangeably, right? They both have very similar guidelines for lending in condominium cooperative developments, but technically they're two separate agencies. Well, Freddie Mac hasn't provided any response to Fannie Mae's guidelines. Freddie Mac has not issued any guidelines in relation to Fannie Mae's new guidelines regarding reserves or deferred maintenance or special assessments. So technically, as of today, Freddie Mac may be the resource for many borrowers and or lenders to provide mortgage financing to condominium and cooperative associations. FHA lending, FHA has not come out with any guidelines either regarding reserves other than the ones that they have that state that you can utilize a reserve study. They have very similar guidelines to Fannie Mae when special assessments are concerned, but not as difficult to comply with. So FHA lending may be a solution for some condominium developments, but it's certainly not a solution for cooperative developments because FHA doesn't provide cooperative mortgage financing. And then the final type of lending that's going to be impacted by these guidelines is CIRA lending. A lot of people don't know what CIRA lending is, but what it is essentially common interest realty association lending. Fancy name for being able to provide mortgage financing to condominium associations. So a condominium association can take out a line of credit to pay for repairs and or maintenance or to do special projects through a CIRA lender, and that payment is made via everybody's maintenance payment every single month. It's added to it. But these CIRA loans are now being impacted by these Fannie Mae guidelines as well. So the point I'm making here is that this is wide ranging. It's literally across the whole entire industry where Fannie Mae's guidelines have had impact and are going to require board members and property managers to make some decisions. And we have an interesting chart for you, which we created. So if you're an established condominium development, which most of the folks on this call represent or board members of established properties, there's two different buckets if you're in a high cost lending area. And the two different buckets are properties that have loan amounts that are often, that are in excess of $970,800 or Fannie Mae's new loan limit, and properties that have, borrowers who are seeking loan amounts that are less than $970,800. Why do we have that number up there? Obviously, it's because it's Fannie Mae's new lending limit, but in properties or loan amounts that are in excess of $970,000, it's not that these new Fannie Mae guidelines aren't impactful. It's just that all of that lending is done through balance sheet or portfolio lending. So a lot, it means that in most cases, you can avoid strict compliance with these Fannie Mae guidelines, but you must provide some sort of ancillary, documentation to these lenders providing portfolio approval, which is likely a reserve study, which is likely outlining what your financial, wherewithal is as a condominium development in order for them to provide a portfolio lending approval. The second type of lending, essentially the choices really are, and this is for any loans that are under $970,000, Fannie Mae alignment and or portfolio approval. So you could still get a portfolio approval on a development with loan amounts that, average less than $970,000 for purchasers or borrowers. But you will likely have to align the site with most of these, new Fannie Mae guidelines. Option 2 is submitting the site to Fannie Mae for a global PERS approval, which is something that we do here at CondoTek for our clients. You might be an association that has $2 million sitting in a reserve account, and it would be, financially irresponsible for you to put a 10% line item in your operating budget because your homeowners are essentially going to be overpaying for reserves. Remember, those funds can never be clawed back. So once they're in that reserve account, they stay in that reserve account. But one of the ways or one of the options here is for that development to align as best as possible, get a reserve study and submit it to Fannie Mae for a PERS approval. And it's likely to be granted as long as there aren't major structural issues or major issues with the financials of that particular building. And the third option, which is a current option, if Freddie Mac changes their guidelines in the future, this may no longer be an option, but is Freddie Mac lending, because Freddie Mac allows reserve studies, has not provided guidance like Fannie Mae has, and has not responded to the industry with new guidelines or commentary even on Fannie Mae's guidelines. So it's an interesting outline. Yeah, Lisa.
I just want to jump in, and I want to make a point that may make everyone just breathe a little bit easier. With the exception of having to have the 10%, and if you don't, you have to have the reserve study that needs to go to PERS. The way that lenders collect documentation to review and warrant a project is no different than what we were doing before. We just are asking more pointed, more prescriptive questions on deferred maintenance, on special assessments. So from a doc collection perspective, and if you're an HOA management company or a board member, what we're asking for is no different than what we were asking for before, except if there is deferred maintenance that we have to dig into, or a special assessment that leaves breadcrumbs to deferred maintenance. Correct, Orest?
Correct. I mean, look, you're dead on, right? The spirit of these guidelines, again, going back to one of the first things I outlined on the beginning of this call, is that Fannie Mae wants to ensure that the infrastructure of a condominium development is maintained appropriately. There are no red flags, no issues that could possibly create a future deferred maintenance and or collapse situation, and that the large mechanical components and the infrastructure and facade and roof are all being maintained properly, and that there's enough capital and cash set aside so that special assessments don't have to be created. So, that's the spirit of the new guideline. And it's not that it departs so far from the previous guidelines. It's just that this new unavailable status that we mentioned earlier and these reserve guidelines that we outlined earlier are really impactful, and boards are really going to have to make some really, really important decisions about this stuff. So there are some recommendations that we have, and we have, scrutinize these new guidelines. Okay. So, and the recommendations that we have are really put together by the expert analysts and risk assessors and underwriters here at CondoTek. They really provide a key understanding and a key kind of, step-by-step outline of what to do. You want to ensure lending compliance. As a property manager or board member, you want to make sure that there's access to mortgage financing in your building. I always equate it to, I had an old boss that, would equate the mortgage industry to, the car industry. And he would say, if you went into BMW, and I'm kind of getting old, I think at the time it was like, if you went into BMW and, they wanted to sell you a car for $45,000, I'm a little old, and they said, give me a check for $45,000, they'd sell very few cars. But when you walk into BMW, and they say it's $400 a month and $1,000 down, essentially that financing creates the market and creates the ability for values to increase and for those BMWs in that example to get sold. So it's the same thing for residential real estate. You have to have established mortgage financing availability, and without it, it's very clear property values go down. So you need to pay attention to this because it impacts every single owner's pocketbook. So what do you do? So the new condo questionnaire is out there. New questions have been added to many lender questionnaires. Lisa, can you give an example of some of these questions that have now been added? Lisa, do I got you?
Sorry, I was on mute there.
No problem.
So I'll give an example of two questions. One of the questions you might be seeing is the HOA or management company aware of any conditions either outlined within the last 6 months of the meeting minutes, inspection, or certification reports, or are you made aware by any other means of project-wide deferred maintenance within the project that may negatively impact the safety, structural soundness, habitability, or functional use of the project as a whole? Another question.
Wait, so stop right there. So think about that question for a second, everybody. As a board member or property manager, how comfortable are you answering the question on whether or not that development, if there's been anything in the meeting minutes or anything about that development can in the future affect the habitability or enjoyment of that property by a unit owner? It's tough without some sort of report behind it. The liability that exists there is kind of great. But anyway, I interrupted you, Lisa. I apologize.
No, that's okay. Another question that you may see could be, is there significant deferred maintenance that has been identified in the project? If so, please outline the nature of the work, completion information, or any capital requirements utilized for the work. So those are examples of two of the questions that you might be asked. And I would think that if you answer yes to either of those, there will be further request for a divulgence of more information really specific to, to what's going on in that project.
Yeah, I mean, and or a request for a report, a request for an engineer's report, a request for a reserve study. The points that we're making are really because we see the writing on the wall. I think in a lot of instances, you will see that, development's answering those questions, and specifically about, special assessments and what they're for and whether or not they're for major, mechanical components. I mean, you have to think about this from this perspective. We recently had a development where they were doing a full overhaul of their HVAC system, but they were doing it in the winter, and this development happened to be in New York City. And the problem was their air conditioning wasn't blowing cold enough in the summer. So they took it offline now in the winter, and it doesn't impact anybody right now, but it's a major mechanical component that there's a special assessment for, and the work hasn't been completed yet. So is that eligible for mortgage financing through Fannie Mae through a full review? Possibly not. And that's why I think without the full review of these developments in situations like that, and the full understanding by a condominium board or property manager of what the implications are, you have to be very thorough about answering these questions with the appropriate documentation behind it. The condo budget is the other thing we've been talking about it the whole entire time throughout this presentation. But the condo budget, it's really important to ensure that there's a 10% reserve line item now, or get a reserve study that's less than 36 months old so you can submit to Fannie Mae for a PERS approval. You have to explain special assessments. Most boards now essentially or have paid for large mechanical repairs or to a development through a special assessment. That process essentially has to end, because the requirement is going to be that you have that capital in your accounts and utilizing it based upon the collection of reserves every single year through the budget, not through a special assessment. And then, as Lisa outlined, the deferred maintenance. I mean, just a major issue right now. Boards really have to be thoughtful about doing the repair and maintenance work that's necessary on these components and doing it in a fashion that makes sense with the direction of a structural engineer or professional or reserve study professional to just make sure it's done right. These guidelines are impactful, folks, very impactful. And Melinda, I just want to check, as far as time is concerned, how much longer do we have? Or Lisa? I wasn't paying attention. I'll continue on.
We are at 2:47, Orest. I think that gives us
10 left. Leave some time.
Yeah, we've got about 10 minutes.
Okay. The other biggest piece of these guidelines, and I've been talking about it throughout this last 45 minutes or so, but the liability that gets created for managers, the liability that gets created for board members by answering questions on questionnaires or providing information that they don't have the answers to, that they don't have the appropriate answers to, that's not based in factual data, that is somehow hiding some issue in the development. Not to say that a board member or a manager would do that, but even if you are, the point is you're supposed to know everything there is to know about the development, or utilize a professional to help you provide that information. I have to tell you that the law firms that we've been speaking to and that work for the property management organizations and that are on staff are really, really, really afraid of answering some of these questions on some developments. They want to make sure that this is buttoned up and that the liability is limited or non-existent for the property managers and board members. There's a few ways to do that. I've been outlining how to do that throughout this whole presentation, whether it's a reserve study or a structural engineer or an inspection on the property, and utilizing that information essentially to answer the questions that are being asked. But, the first bullet, Fannie Mae is requiring lenders to ask these questions and to make very specific determinations about these properties based upon the questionnaires that are going out. Reducing board member and property manager liability is kind of first and foremost right now. And look, nobody wants a Surfside on their hands. Could you imagine being one of the board members of the Champlain Tower in Surfside? I don't want to be alarmist. I don't think that that's, accurate, entirely. I think that, I think there are very few condominium developments or cooperative developments across the country that suffer from such deferred maintenance that could be a possibility. But there are a few, and it's kind of one of these things where I don't want my name on that, and you as a board member or manager shouldn't want your name on that. And in some cases, you're taking the life of other people in your hands, and you're answering these questions appropriately, in order to prevent a tragedy. Again, obtaining reserve studies is probably one of the best things to do for a condominium or cooperative association. Qualified representatives are really important. With qualified representatives, it's really important to have the right people on the site making the judgment calls about the structure and infrastructure. And of course, limiting the liability in the best way you possibly can. You know, the financial condition of a property has to be reported. The structural condition of a property has to be reported. In both instances, you know, you wouldn't have a plumber telling you about your, you know, reserve account or your working capital or your operating account. You know, you have a CPA, right? So it's really important to have the right professionals here in providing information to boards and managers. Oh, well, that was a mistake. Hold on a second. Let me realign that. Can we still see that, everybody? Lisa? Or do I have to reshare it?
Not quite yet.
Okay. Sorry about that. All right. Now you can, correct? You guys can see it?
Yeah. Yes.
All right. Sorry about that. We went over liability services. So what does CondoTek do? What does CondoTek do? Essentially, we provide all that portfolio, Fannie Mae, Freddie Mac, and FHA approval where appropriate and available. We provide loan level compliance reviews for our lenders. We provide this product called the Co-op Pack and the Condo Pack, which are essentially providing all the condominium documents to lenders for review. And now we provide this condo project warrant for our lenders, where not only do we collect all the documents, but we do the reviews on these condo and cooperative developments and warrant them to the lenders that are lending in these sites. So our role here is really interesting because we're providing this information, but on the other side of that is we're ensuring that all of these things are compliant for the lenders lending in many of these sites, for hundreds and hundreds of lenders across the country. So our goal here is to really ensure that these projects and these developments are, compliant. You can contact myself or Lisa. Pretty easy to find. Orest at CondoTek.com, Lisa at CondoTek.com. We want to make sure that we had a little bit of time left at the end of this presentation if anybody had any specific questions. So if there are any questions, we'd love to answer them right now to the best of our ability. You can type them into the chat. Melinda will read them out and let us know what they are. And happy to answer anything you have. If not, if you don't have any questions, Melinda, are there any questions that have been asked?
Not yet.
Did I do such a good job? So this presentation will be available on our blog. We'll have that uploaded likely by tomorrow. Happy to provide any guidance, any information anybody on this call has. All you have to do is email us. We'll give you our take on these guidelines, our take on the specific situation you have. We'll answer any questions you have about developments. And of course, we could provide the services that you may need in order to get your condominium projects and cooperative projects approved, either through portfolio approvals or Fannie Mae approvals or FHA approvals, and help you get down the road to ensure that these buildings are compliant. So we're going to give you a little bit of time back today since there are no questions and since I did such an exceptional job. Lisa, thank you very much for being on this call. It's always a pleasure, and it's always great to have your opinion here. So
Thank you.
And thanks, Melinda, and thank you all for joining.